on God for you. No, for you. It's not your fault, it's how you were raised. Excuses, really all that you say. Better to play, you can't seem to share. Every other day you forget how to care about me. About me, what about me? About me, forget me. What about me? Used to be like BB. You're my sweetie, only child. Because you're so stingy, I just wanna go buck wild when you don't defend me. I've been on the fucking prowl, I've been counting minties. You didn't turn my heart so cold, I should work it freely. Darling, darling, I've been praying for you, for you, for you. You ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless, you ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless.
Every move you make, man, I swear it seems suspicious. Lying through your teeth, so I don't rush to give you kisses. Spiteful and malicious, hope that other chick got syphilis. Sick of this, hard to stomach now that nigga shitting bricks. Hypocrite, punch you in your lip, oh shit, you slipping sis. Used to arch my back for you, and now I'm your arch nemesis. All men should be feminists, Donald Trump pros immigrants. I don't want to work it out, so cancel our gym membership. I'ma lead this nigga, don't believe me nigga. I was make believing nigga, it was only one season nigga. M.O.D. my nigga, money over dick, money over dick. You should stop breathing, nigga.
You're my sweetie, only child. Because you're so stingy, I just wanna go buck wild when you don't defend me. I've been on the fucking prowl, I've been counting minties. You didn't turn my heart so cold, I should work it freely. Darling, darling, I've been praying for you, for you. I've been praying for you, I've been praying for you. I've been praying, I've been praying for you. Darling, darling, I've been calling on God for you. No, for you. You ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless, you ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless. You're my sweetie, only child. Because you're so stingy, I just wanna go buck wild when you don't defend me. I've been on the fucking prowl, I've been counting minties. You didn't turn my heart so cold, I should work it freely. Darling, darling, I've been praying for you, for you. I've been praying for you, I've been praying for you. I've been praying, I've been praying for you. Darling, darling, I've been calling on God for you. No, for you. It's not your fault, it's how you were raised. Excuses, really all that you say. Better to play, you can't seem to share. Every other day you forget how to care about me. About me, what about me? About me, forget me. What about me? Used to be like BB. You're my sweetie, only child. Because you're so stingy, I just wanna go buck wild when you don't defend me. I've been on the fucking prowl, I've been counting minties. You didn't turn my heart so cold, I should work it freely. Darling, darling, I've been praying for you, for you, for you. ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless, you ain't never think about nobody but yourself. Selfish, but I really can't wait until you're gonna need my help. Helpless.
Every move you make, man, I swear it seems suspicious. Lying through your teeth, so I don't rush to give you kisses. Spiteful and malicious, hope that other chick got syphilis. Sick of this, hard to stomach now that nigga shitting bricks. Hypocrite, punch you in your lip, oh shit, you slipping sis. Used to arch my back for you, and now I'm your arch nemesis. All men should be feminists, Donald Trump pros immigrants. I don't want to work it out, so cancel our gym membership. I'ma lead this nigga, don't believe me, nigga. I was make believing, nigga. It was only one season, nigga. MOD, my nigga, money over dick. Money over dick. You should stop.
All right. We have a lot of people trickling in, but there's so much to cover, some awesome guests coming in, so we want to get started. Awesome to see a lot of the names joining. I see some familiar faces. Sarah, good to see you. It's been so long. If people could start throwing in the chat just where they're dialing in from, it'd be amazing to see where we're getting people this time around. Usually we're lucky enough to have a great international crowd, so we'd just love to see where people are joining from. DC, I'm originally from Virginia, so I know the DC area well. Got a lot of US. Wow. Australian, Israeli from New Jersey. Love it. No South America this time? There we go. Bruno from Brazil. Muito bom. Okay. Let's get started. I know there are some people that have been to many of these presentations, but some of you have not. So let's make sure that you guys are in the right place. We're going to be covering SaaS funding in 2024, and we have some amazing guests that'll be joining us halfway through it. But we do have people from very different backgrounds and different stages of progress in their journey around venture capital, venture-backed startups. So we're going to spend a little bit of time beforehand getting into some of the baseline stuff. To help me out, would love to launch that poll. I don't know if Paige or Jonathan can do it, but we'd love for you guys to answer just where you are in your stage of fundraising, so we kind of have a sense for what this audience sounds like. Let's see. Polls live? Yeah, great. I feel like during the poll, I should be playing music too.
I have about 64% answered.
Okay. What's in the lead right now? I guess I can't see this.
I'm going to wait to tell you.
Awesome. Checking in here. We have people from Chile, Kenya. Thomas from Orange County. Good to see you again, man. San Francisco. Just for people to know, I will be coming to San Francisco next week. Hopefully people can join me for coffee.
All right, I think we should be good to end it now.
Okay, let's share this out. Thanks, Jonathan, for sending that screenshot. We have a good mix, but a lot of people who have not raised capital before, which is good because we will spend a little bit of time in the beginning to do some baselining so that when we have our expert guests come in, we'll have a little bit more surface area, a little bit more knowledge to really prime some great questions. So let's jump back in. I want to do a little bit of housekeeping. So a lot of you have your cameras on, a lot of you don't have your cameras on. It would be amazing if you put your cameras on because I'll be talking with you, interacting with you. And one of the ways I gauge whether or not I'm doing a good job is if, Abby's smiling like she is, or if Arvind is kind of furrowed with her brow and his brow and not sure what I'm saying. So please keep your cameras on. I'll be looking at you, making sure that it makes sense. Note that the Zoom chat is open. After 3 years of doing this on a monthly basis, we know that the Zoom chat is an awesome place to be, an awesome place to connect with cool founders. So feel free to be engaging there. A couple of people on my team are keeping track of what's going on there in case I need to chime in and answer any questions. So Q&A is going to happen at the end with Rhett and Peter. But if you drop questions in the chat, like I said, hopefully we'll look for those. And if they're important enough, I can answer them. And then if there are any insights that come out either in my initial lecture or the conversation with our guests, feel free to share them on social. If you tag us, we'll try to amplify your messages on social too. And I always like to say, we're not doing this to protect the information. We want as many people to benefit from this content as possible. And then if you've never been to one of my sessions before, you should realize that they're quite interactive. And if there are points in time where there's opportunities to interact, I would volunteer. I think the people that volunteer and interact with me get the most out of these sessions. And then as a primer for some of the stuff that we're going to be doing, start thinking about your business right now. The basics of your business. What goes into your business? What do you sell? How do you make money? Because we'll do some interactive exercises at the end. So here's the agenda. I want to go through some background, make sure that people understand why we're doing this, go into some interactive thought exercises, and about at the half hour, we're gonna kick off the fireside chat with Brett Queener from Bonfire Ventures and Peter Walker, the head of insights at Carta. We'll reserve time for Q&A because that's kind of the best part, is picking these people's brains. Okay. If you've never been to one of my sessions, I always try to share a little bit of my background. So I was the head of new media products at MLB.com, after which I was a venture capitalist at Greycroft, generalist investor doing all sorts of deals, everything from gaming to fintech to enterprise SaaS. Before becoming a SaaS founder myself, raised millions of dollars for tape, had a small exit in 2020, and then transitioned this line of work where I was first an internal fundraising coach for Silicon Valley Bank before launching my own company, Adamant. That's what I run right now. Focus is making fundraising easier and more accessible for as many founders as possible. And I do that in a lot of different ways, workshops like this, weekly newsletter, podcast funded. And so why do I give you this background? Well, the background is not there to gas myself up or to make myself feel better, although it does make me feel a little bit better. It really is to give you context. It's really to give you context for the advice that I'm about to give and to prime you to think about context for the things you're about to hear from our two guests. Why do I do that? Well, I always start off by sharing this kind of insight. So these are two investors. One is Andrea Funston, who's now a partner at RTP, and the other is Mark Suster, managing partner at Upfront Ventures. And what I always say is, in this game of startups, but especially fundraising, you could find two equally credible people who will give you 180-degree complete opposite pieces of advice. So if you look on the left and the right, both of these pieces of content are talking about when founders should share data rooms with venture capitalists. On the left, Andrea is like reminiscing about having a conversation, a first conversation with a founder, and immediately after this founder gives an open data rooms and shares everything. And Andrea is like, that is the most amazing signal. It's amazing. Everyone should do that. On the right, Mark Suster has a blog post that essentially says data rooms are where deals go to die. You should never share your data room. Now, how could that possibly be that two senior partners at well-respected venture firms would share the exact opposite pieces of advice? Well, what everyone has to realize is that when you share advice in soundbitey formats like Twitter and even blog posts, it's easy to misinterpret. I would venture to guess if I had Andrea and Mark sit down over coffee and discuss their thoughts on data rooms, they would actually probably agree on most things. It just happens to be how these pieces of advice have been shared. And so this is my push to you all. In any sort of forum where you're receiving advice around startups, around fundraising, it's your responsibility to dive a little bit deeper, try to understand the underlying principles under which these pieces of advice are being given so that you better understand how to apply them to yourself. One of the best ways to do that is to say, what's this person's background? How did they develop their information? How do they develop their knowledge? Does it sound like something that I could relate to? And if so, maybe that helps me understand how they came up with their perspective. So think about that when you're going through any of the content today. Think about that when you're listening to what Brett has to say and what Peter has to say, but be overly critical about some of the advice that you follow. Okay. So moving on, today's focus, what we want to talk about really is this idea of convincing SaaS investors. Convincing SaaS investors, I think a lot of you must be SaaS founders. And so we're going to start with some baseline information to make sure we understand why we're doing this. Because a lot of you are in SaaS, I would imagine a lot of you have had some exposure to sales, right? You guys are building products that are selling to enterprises, and at some level, you're going to need to be selling. So I want to start off this little information part with a fun little interactive, illustrative exercise. If you've been in sales, maybe you've seen this interview question. Sell me this pen. I'm going to have to go through the list of people here to find people who I don't recognize. But I'd like to call on someone randomly and have them do this exercise with me. Let's see, Stephanie Veal, are you available to chat with me?
Hi, yeah, I can chat.
Amazing. How are you, Stephanie?
I'm great, thank you. How are you?
Good. Sounds a little bit of an accent. Are you from Alabama?
No, I'm from Australia.
I'm just kidding. Yeah.
Oh.
Where
Sorry,
in the
the
world are
screen
you?
just went to a different screen. I'm in Austin, Texas.
You're in Austin, an Aussie in Austin. Okay.
Yeah.
Have you ever seen that interview question before for salespeople? Sell me this pen.
I have, yeah.
You have. Okay. Well, let's do the
I've never been
exercise.
asked it. Well, I've never been asked it.
Oh,
I've
you've
seen
never
it
been
as
asked
a,
it.
as a
Okay,
concept, yeah.
Great. So you and before we get into this, I want to give you an opportunity to be cold called in practice. Can you tell me in 30 seconds what you're working on?
What I'm working on? Well,
Yeah.
I work for Flipper, where we help support digital business owners in like exiting or acquiring new opportunities.
Love it. Good to have you here, and good 30-second pitch.
Thank you.
Now let's do the exercise. So do you remember the image of the pen? Should I flash it one more time? See this pen?
Mm-hmm.
Okay. Can you try to sell me this pen?
Nothing like being put on the spot, hey?
It's okay. Yeah. You are the sacrificial lamb so that everyone else can learn. But don't worry, like it's not an easy thing to do, and there's no real bad way to do this.
Am I selling this particular pen or the concept of a pen?
That particular pen that you saw the image of.
Oh man. Jason, I don't even know where to start with this.
You can start, just try. It's okay. Like most people like have this challenge, and we're just going to illustrate why this is so important. So how would you start? If you had a pen in your hand, how would you try to sell me on the pen?
All right. Well, the Wolf of Wall Street's coming to my mind. I would want to say, write down your name.
Okay. I'm writing down my name.
Create some need there. Jason, I'm completely blanking. I'm so sorry.
That's okay. That's totally okay.
I feel like you should get someone else up.
No, I'll try someone else. Maybe a startup founder.
Thank you.
No worries. And don't worry, this is not an easy exercise. And when I cold call someone else, it's not going to be easy for them as well. Rob has already seen this, so I'm not, even though Rob is raising his hand. Let's go with Arvind. I'd seen you before. Arvind, how are you, man?
Hi, how are you? I didn't raise my hand, but I mean, I can give it a shot.
I know you didn't. This is a cold call. First, where in the world are you?
I am currently in India.
Oh, amazing. Do you have a startup?
Yes, I do. Yes, I do.
Give us 30 seconds on what your startup does.
We basically solve the 0 to 1 journey for most startup companies, which means we solve functions like product, marketing, design, etc. So we basically try to get the 0 to 1 journey right using our team of fractional CXOs that we have.
Amazing. Good 30-second pitch. And by the way, as I'm cold calling people and asking them to give me their answers, I don't want Leticia to be laughing at Arvind and saying, "Oh my God, look, I didn't get called on." What everyone should be doing is when I ask these questions, you should be simulating how you would answer these questions. Let's try to get you guys as many reps as possible, because you need to be great at being able to describe what your company is in a short situation like this. So anyways, Arvin, good job on the description on the cold call there. So let me flash this pen for you again, and just see.
Yeah,
Do you remember
I
the
just want
pen?
to see.
Yeah. Check it out real quick. Pretend like you're holding it. You're sitting in front of me now. Sell me the pen.
Right. All right. I guess if I were to just sort of fundamentally think about it, I would probably just start off with a few questions. I'd be like, hey man, what do you usually write with?
Cool. I write with a bunch of different things. Sometimes pencils, sometimes pens. I also have uh, a digital pad.
Right, right. Have you ever stuck with a particular pen or a pencil or anything, something that has sort of meant something to you?
Yeah, I have a pen that my grandmother gave me back in high school.
Do you still use it on your everyday, day-to-day basis?
I do. Yeah. Not every day. But special occasions.
Why do you not use it every day? And why not for special occasions? And why only for special occasions?
Because I'm usually on my computer.
Okay, all right. When you use it for special occasions, do you use it only for, like, I'm gonna guess here, signatures? Or do you use
Or
it
like
just for like
yeah,
birthday
like
cards?
personal messages.
Okay, all right, all right. So I mean, the way I want to sort of kind of pitch this pen to you is I would rather have you not wasting a lot of pens and papers. What I think is, like, if I believe that you are a founder yourself, right, and you hold yourself to a high amount of integrity, I think you should stick to one pen. All right. Your
Arvind,
grandma's pen is something that's great for.
great job. But no, great job, by the way. Honestly, call it, I mean, Paige and Jonathan can chime in here. Probably top 10% of answers in terms of how close you got to what I would look for.
All
So good
right.
job there. What I actually will tell you is that most people, when they're given the question of sell me this pen, the first thing they will do is they will talk about the features of the pen. They will say, this pen, it's got an amazing black ink. It's
Oh, never, never.
it's really easy to hold. It's got a great grip, and they'll just start selling and say, this is the most amazing pen you've ever seen. And if you know about sales training, which I think Arvin maybe has gone through some, most standard sales training will say to be a great salesperson, you have to get into the mind of the buyer, right? You have to understand why someone's buying before you can sell them anything. Usually, what I tell people, actually, the best answer to the sell me this pen question, Arvin was close, is really just to be like, I'm excited to tell you about this pen, but like Arvin was saying, I have some questions, and just say, tell me a little bit about yourself. Tell me a little bit about your business, right? Because you really want to understand, what is this person interested in? I might say, I'm looking to design the most amazing desk in the world that looks very intelligent. And I want a pen that catches people's eye. And that could also be a paperweight. Once he uncovers that, once he goes really deep there, he knows that the only thing he should be talking about is how beautiful the pen is, how heavy the pen is, how easily it holds down papers. Nothing about writing, right? And the reason I give you this long drawn out example is that I believe that the majority of founders who go into fundraising, even ones that have actually raised a little bit of money before, don't go deeply into this understanding of investor psychology, of understanding the mind of the buyer, the mind of an investor. And so we're going to spend a little bit of time before our guests come in 10 minutes to talk through this, so that you have an understanding for where they're going to come from. And then we're going to have an open conversation with Brett, with Peter, try to figure out what's going on in their minds, and then open it up to Q&A. Okay. So it really is, I love AI now, where I can just be like, what's an image that shows like getting into the psychology of a SaaS investor, right? And they just spit out a psychologist talking to an investor, which is great. So I want to go quickly through these concepts. One of the things that I want everyone to grasp is that this idea of being venture backable as a SaaS startup, right? What does it mean to be venture backable as a SaaS startup? And one thing that I want to make sure people know is this idea that not being venture backable does not mean you run a bad business, right? After I finished my last stint as a venture-backed founder, I was like, I still want to be in SaaS. I still want to build SaaS companies, but I was like, I want to build one that I start making money immediately from or very soon after. I wasn't thinking about raising venture capital dollars. And that doesn't mean that I had a bad business, but it is very important that you all understand what type of business you're building before you decide whether or not it makes sense to raise venture capital. Right. I'm going to show you this. It probably seems extremely simple for most of you, but I do want to underline this fact that when a venture capitalist is investing in venture-backed businesses, they are looking to themselves to say, not, is this going to be a good business? Not, could Victoria make some great money for herself in events in Brazil? But instead, could this be so massive that when this one company hits, it covers all the rest of the bets that I made that all went to zero, right? And that means that every one of their bets has to have the potential of going massive in order for portfolio theory to work for them. They have to think that all of them have this crazy outcome, or like either crazy outcome or essentially a zero in their heads. Otherwise, it doesn't work, right? If they use one of their bets on Jonathan and it was a pretty good business and it happened to be the one that hit, but honestly only sold for $50 million, that is great for the founder, but it doesn't work in VC portfolio theory. Okay. So when we think about what it means to be venture backable, there are two things that I want people to think through. One is that, again, is the business that I'm running something that could have massive potential? And then a venture capitalist will go, okay, if I check the box there, can this team do it? Do we believe in Alex? Do we believe in Jesse and their abilities to actually bring it to the promised land, right? Instead of focusing on number two, I want to do a quick math exercise to make sure that people are even thinking in the realm of massive potential for their own business. So remember I said, think about your business, keep thinking about your business. We're going to go through a really quick math equation, right? So when it comes to math, why does math even matter? Well, it matters because of what VC expectations are around returns, right? So we need to understand, what does it mean for a VC to look at Henry's business and say, it is a business that I think will return what I expect it to return. If he's raising a Series A from me at a $40 million valuation, do I think it could actually get to 400 million? Do I think it could actually get to $1 billion, right? This is a type of pretty basic thinking that I want to make sure you guys are wrapping your heads around, so that when you start talking to VCs and you start telling your stories, that you know what direction these need to get into, right? So we're going to walk through what investors need to believe, honestly, from a simple math point of view. Okay. So let's go through this math. This will be the last exercise before we bring on our guests. But here's what we're going to talk through. Here's the math exercise. Let's see if you guys can do this and write them down. We're going to start with this idea of, what is your expected valuation? You know, what do you think your company is worth today based on what you've heard other people say, companies at your stage? Like, if you were to raise money now, what valuation do you think you could get? Okay. Take that, actually write that down, and don't worry, no one's going to like look over your work and hold you to it and decide whether you get money for this, but do that. Put it down. What do you think you could get to? Now, what is the VC return expectation for your stage? So I'll flash that back up here again, but look at these really broad-based return multiples. These are the expectations that people have. So write down whatever you are. Are you pre-seed or seed? Are you Series A? Are you Series B? I think a lot of you are going to have to take down this 100x mark. Now, with that expected valuation and that VC return expectation, you multiply those two, and that's going to be the target exit value. I'm going to cold call one person here. Let's see. Abhishek. How are you, man?
Doing good, Jason. How are you? Good.
Where in the world are you?
Vancouver, British Columbia.
Okay. Beautiful. My My sister's up there in Whistler right now. Do you want to give us 30 seconds on what your startup does?
Yeah, so we provide short-term equipment financing to US-based companies which cannot get those financial products from banks because they
Amazing.
have certain industry regulations and considerations.
Good stuff. Good job on the cold call. Would you mind sharing what your first two numbers were? Your expected valuation and then the VC return expectation and the final target value?
Yeah, the VC return would be 100x because we're looking to raise our first round pre-seed.
Yep.
Expected valuation, hard to put a number on it today. We're post-product. We have a decent sales pipeline. We're onboarding our first few customers. We have an idea of what our net take is on these financial products, but I haven't gone through or
Pick a number.
So is this post money or pre money?
Post.
Expected valuation post. I'd say 8.
8. Okay. So 8. So what are we saying that a VC needs to believe that you could exit for minimum?
What?
To be 8 times
$800 million.
$800 million. Awesome.
Yeah.
Great. So $800 million. This is kind of fun, right? You're thinking in your head, like, this is what VCs have to believe. Now you're thinking, Abhishek, founder and CEO of $800 million exit company. What does it mean for a company to be $800 million at exit? This is the thing that we should all be thinking through. So you guys, everyone else, not just Abhishek, you've gotten to this point in the math. I want us to fast forward through a couple other slides. And Abhishek, thanks for volunteering and being put on the spot. What we want to do is just actually walk through this idea. So how do you calculate an exit value? Well, there are a couple different ways that at scale, people value companies. If you did it, you really should be doing in-depth analysis of future cash flows, discounting them to the future, adding them all up, and then saying, okay, this is how much this company is worth today. But there's a shortcut that people use, investment bankers and venture capitalists, and it's this idea of valuation multiples, right? So valuation multiples just say like, well, if company is doing X amount of revenue, the revenue multiple, well, then we like applying this one valuation multiple to say, okay, this is how much its total enterprise value is. And right before this, I looked up valuation multiples in the public markets, and they're hovering right around, call it 10x. Salesforce is at 8, Workday's at 9, HubSpot's at 11. Maybe it's because HubSpot keeps talking more about AI. But what we're talking about here is SaaS valuation multiples right around the 10x mark. So when we think about that, what I want people to then start thinking about is, what does it even mean to be an $800 million business? Well, an $800 million business divided by the revenue multiple of 10x means you would likely need to be doing $80 million of annual revenue every year to be valued at like an $800 million valuation using this valuation multiple. And the level that I want you guys to be thinking about is, some of you might have done the math where you're at $2 billion, like based on what you need to return for a startup, for a venture capitalist. But after you've done all of that math, the revenue at exit, so Abhishek's at $80 million, he's providing equipment financing. So how does that business model work? How big does his business need to be in order to generate $80 million of revenue every year? Okay. This is one exercise that I want people to go through, because a lot of times people will be there in the beginning days and be like, well, I charge $10 a month, $100 a year on annual contracts. And holy crap, I need to be doing $100 million of revenue a year in order to be as big as a venture capitalist wants me to be. And a founder hasn't even thought about that scale yet, has never thought about that scale before going out to pitch venture capitalists. And I just think going through that exercise and making sure you understand what that scale means to yourself will help push you in a direction that really allows you to unlock both where you want to bring your business and also the story that you want to tell venture capitalists. Okay. So that was our interactive exercise to just understand what it means for you guys to be venture backable, what that story behind what you do is going to have to sound like. And now it's exciting. We get to talk a little bit first about, we'll say some nice things as Brett and Peter come in. But after all of that, a little bit of a baseline around being a venture backable SaaS company, we get a chance to come and talk to two experts in the space to really pick their brain and understand what they've seen. So we're excited to have Brett Queener, Managing Director at Bonfire Ventures, and Peter Walker, the Head of Insights at Carta here. Just a few fun facts about both of them. And I don't want to mess this up because I'll leave the floor for Brett and Peter, but at least with Brett, we know that Brett has been part of some huge growth stories in SaaS, joined Siebel before their $5 billion acquisition, joined Salesforce pre-IPO when they were just a little baby doing, 90 some million dollars of revenue, watched it go all the way up to something like 3 billion, managing a big portion of that revenue before becoming COO of Smart Recruiters, directing them on their path towards becoming a unicorn, and then doing some amazing investments along the way. He now is a managing director at Bonfire Ventures, a SaaS-focused seed investing firm. And then Peter Walker, who I've followed for a long time, who manages the insights around Carta. So head of insights around Carta, you can imagine the type of data he has access to. He produces some of the best content out there when it comes to understanding what's going on in the venture world. He also worked on some amazing projects, I think he worked on the COVID projects, analyzing the data behind that. So we're excited to talk to both Brett and Peter. I want to spotlight you all. Let's see, where's Peter? There we go. There's Peter. Where in the world are you before we get started?
Hey, Jason. I am calling in from San Francisco.
Amazing. And Brett, you are in beautiful, Santa Barbara? Santa Barbara. Okay. So before you guys jumped in, we were talking to this group of founders about what it means to be a SaaS founder and what it means to be a venture backable SaaS founder. The reason we pulled this together is because there have been so many questions about what's going on in the market. The last 18 months have been crazy, and I think a lot of founders' heads have been spun around. So what better people to talk to than someone who's seeing all the data from inside cap tables, et cetera, and someone who literally grew up his whole career around SaaS and now is investing in it. So I wanted to start with some easy questions, maybe 30 seconds from Peter around your words, the words that you use to describe what Carta does and what you do within Carta, and then the softball question that I had asked you before. So first, your background in Carta.
Absolutely. So I run the insights team at Carta. Carta is a cap table management software, first and foremost. We manage the cap tables for about 40,000 startups across the US and globally. We also manage about 2,500 or closer to 3,000 back offices for venture funds. So both fund data and portfolio company data, we can combine that in really interesting ways. And then my job is to make that data more useful, hopefully to founders like yourselves, with all sorts of content and big reports and just any way that we can get sort of market data into the hands of the people who need it the most.
Yeah, it's amazing. I mean, if you think about the data that you get a chance to see in aggregate, of course, sure. Anonymized and in aggregate, it is amazing, right? There is a little bit of a lag, right? You see the data come in, but that's part of the fun of your job of analyzing it in the right way. And so the question that I had asked you to prepare for was, out of all of the data that you've seen specifically around SaaS startups, especially over the last year, are there any bits that come to mind for you that you'd want to share? Because like you share some awesome graphics, but you don't share all the data that you see. Anything come to mind?
Jason always asking for the hidden stuff, the secret data. I love it. Yeah, I think a couple of, I'll respond to that with two main points about SaaS companies in particular. So I think everyone is aware that last year was a tough year in venture overall, but a great year if you were building an AI company, or at least it felt that way. The heart of the AI investment was actually deeply within SaaS. So there's AI in every category, biotech, pharma, hardware, all over the place. But the boom is sort of founded and growing fastest in SaaS. So SaaS AI was the biggest growth category for across Carta companies last year in terms of total dollars invested, valuation growth, et cetera, et cetera. So that's one thing. That's a tailwind for 2024, hopefully. And then the other thing that founders should be aware of is that when you look across the whole startup ecosystem, it can feel like every deal with an investor is really hard, and they are, and you have to negotiate on the terms in the right ways and everything. But in terms of how much of your company you're going to end up selling to investors, it's less in SaaS than it is anywhere else. So it may feel bad that you're giving up 20% of your company in a Series A round if you're a founder, but just know that if you were a biotech founder, that's more like 25 or 30%. So perhaps that's a great way to just be like, look, this is not an easy fundraising environment, but it's actually a little bit easier for these core SaaS models than it is for some other businesses.
Love it. Great answers there, Peter. And yeah, I had always wondered how we categorize AI and where it's having the biggest impact. And it does seem like, based on the data and just anecdotally, it is happening a lot in SaaS. Yeah. So thanks for that background. I want to transition over to you, Brett.
I don't have a pretty slide though.
Do you have a pretty, well, the one with your face, I thought did pretty well.
You told me that Peter was going to be a rate buster with the slides. All right.
I don't want to show anybody up here, Brett,
Brett, before I ask you a little bit about your perspective, I wonder if you could spend 30 seconds describing a little bit more about Bonfire, what you guys focus on, and if you have any specific focus yourself within Bonfire.
Sure. So Bonfire is a seed stage software investment fund. We invest at the seed stage and what I would call as traditional seed. We write $2 to $3 million checks when companies have product in market, at least 5 customers we can talk to. Generally, call it 3 to 400K in ARR. Because one thing that people don't talk about is labor got like 4 times more expensive over the last 6 years. And what you used to raise to get to $1 million in ARR, where the benchmark is moved to 2 to 3 from a Series A and people cost you a lot more, is you need more time and money. I would say our focus and differentiation, look, there are hundreds of seed stage software companies, venture firms. We're hands-on, we're pretty concentrated. So we're in a third fund, it's $175 million. We probably will do 25 core positions, reserve 60% for follow-on, and we get pretty engaged. I like to say we are hands-on, but fingers off. These are founders' companies, but we bring a lot of experience in software. I've been doing it for 30 years. My partners, Mark and Jim, have been investing it for 20 years. I know everybody thinks that their SaaS business is super different and special and a snowflake, but the reality is there are some playbooks to follow, and it's not that we're super wise. What I like to say is that my wisdom comes from anything you've tried to do as a founder. I've fucked up 6 ways, so if I can say, hey, don't do that, like that's going to be a problem. Like, I'm on a board of a company, it's over $200 million. And they were like, we're going to do Hunter Farmer. We're going to split new sales and add-on and enterprise. And I was like, the dumbest thing I ever heard, but knock yourself out. And then a year later, they're like, yeah, that was dumb. We're not going to do that. But what you can't do as a board member or a venture capitalist is say, I told you so.
Right. That doesn't feel great.
What I would say is we're small but mighty. Initially was focused in the Southern California tech ecosystem, but spread across most of the United States in terms of investments. And Newcomer did their first ranking of top VC firms as referenced by, they asked founders, would you pick the same investor again? We came out like number 4, and I think that scared like all the big firms, and then they spent all their money and all their resources. I think we got knocked out of the top 10. But being in the same company of folks like First Round and Union Square Ventures means we're doing something right.
That's awesome. Well, it's a good transition into some of the questions I wanted to ask, and we'll keep Peter on the side in case data pops into his head about this, but you used a term that I think is worth jumping into because I think it's confusing for everyone, including venture capitalists. You said we invest in, I think you used the term, what I would consider traditional seed, right? And I think that's where I want to start, which is to say, can you subjectively first describe what you mean by traditional seed? Like, what is it that you're looking for in a company that makes it seem like it's ready for what you would call traditional seed?
Yeah. Look, I'll say, what do we look for that hasn't really changed? Look, we look for amazing founders that aren't going to be stopped, who when we talk to them, they started this business because they couldn't imagine not doing it. Because startups are really hard, and they're not. It's not rationally smart. Remember when the founder of NVIDIA said if he had to do it all again, he wouldn't have started NVIDIA. For us, there's product in market. Version 1 of product is in market. There's the foundation of a strong technical team, and we have to believe that the product is at least a 3 to 5x better mousetrap. If it's just slightly better, it's never going to be economically efficient to keep throwing venture dollars at this opportunity. There is customer love. Like, I will say, the biggest thing for us is we talk to a couple of customers, and I ignore everything they say rationally, and I just try to listen for emotion. Like, are they emotionally connected to this company because this company feels like they're going to make them a hero in their company? We look for about 3 to 400K in ARR traction. Something less than that is too small as a signal. And quite frankly, if they're less than that, if they're raising a traditional seed round, they won't be able to raise enough money. They don't have enough money to get to where they need to get to at A. Because in our mind, like, you need to give the founder time to make, for every decision they make from seed to A, half of them are wrong.
Yeah.
And that's where you learn, and they have to have time to that. But this idea where oh, we're going to go from 1 million to 2 million by the end of the year and cash flow broke even, and we're going to all figure it out. Like, no, you're not. And that's okay.
Yeah.
And then, of course, look, there has to be a large TAM. I think the market got a little wacky over the last 10 years where the first 5 to 10 years of SaaS investing was easy. The entire software category was on-premise. Somebody came out as the first SaaS provider, and they got funded. And then in the last 5 years, there's 50 in every single category, right? And somehow your bet is that they're just going to go out and execute. And that's really, really hard. So that's what we call traditional seed. And when I say traditional, it used to be you started a company, you sort of self-funded it. There was a friends and family angel round. Fortunately, there are now, in the last 5 to 10 years, there are pre-seed investors where there's institutionalized investors that invest at the pre-seed round. And then when we invest, which is, we're writing 2 to 3 into like a $3 to $5 million round that gets a company beyond 2 to 3 million in revenue and kind of on their way.
Nice. And Peter, he said something that I think you have good data around. I'll actually flash this up because I just pulled it down. But this idea that it's taking longer, or it takes longer for a company to prove out their Series A. I think you're seeing that data, right? Let me just share this right here.
Yeah, completely. I think there's a lot of people that have been surprised, candidly, by how long it's taking to raise their next round. It used to be the general typical advice was 18 to 24 months. You can see if you follow those black lines there between seed and Series A, that first column on the right-hand chart, that's right now looking like 2 years close to 2 years as a median. So the average is well above 2 years. And you can imagine the higher part of the distribution is even quite above that. So if you are expecting that the cash that you raise in a seed round is going to tide you over for, you're going to be able to raise again in 12 months, I think that sort of expectation is out of date. I will say there's a lot of creative financing happening in between these primary rounds, safes, convertible notes, bridges, insider leds, et cetera, et cetera. Those are all happening. They're all great, but go ahead.
I was just we have there are a lot of creative names, C plus, A minus, et cetera, that pop up.
Yeah, seed junior, like what there's always some fun ones. I think I actually really liked Brett's description of what a traditional seed round has been. I think the biggest change that's happened over venture in the last 3 years or so is just the number and size of pre-seed rounds. If you just consider pre-seed anything that's not priced equity, like so much more fundraising is happening on safes these days. And founders are choosing to do multiple safe rounds, which again, it's not a bad thing necessarily. It does kick down the road some important conversations that due diligence might help in a price round, but it's the way of the world at the moment. So founders should just be expecting that they may end up using the safe for longer than they initially anticipated.
Nice. I have one last line of questioning and discussion before we open it up to Q&A. Brett, I just want to make sure, Brett and Peter, do you have a hard stop at the hour? I want to respect your time.
No, I can go.
Okay, let's go maybe 5 minutes over with you guys. So the question the thing that I've been seeing a lot of anecdotally, and I think Peter and I are going to work on some data to see if we can back it up with real data, is this idea that, Brett, the round that comes before you, or all the money that comes before you, we used to think about this pre-seed, and there was a period of time in 21 and 22 where people were like, I'm going to raise like a $2 million pre-seed. And what do you have? Well, like I have a product, I have a proof of concept, whatever, but I'm using this money to go and then get to the seed level. What I'm seeing anecdotally is that like oversized pre-seed, the 1.5 to 2, is going away, or is kind of going away. Like I just don't see that happening, or pre-seed firms being excited to play in that dangerous space. They would rather kind of edge up to the seed and be like, yeah, we're just like Bonfire. We need to see $500,000 of ARR, or I don't know, do something smaller. Have either of you, I'll start with Brett. Brett, have you seen this kind of dynamic play out? And what does it mean? Like, what does that, if it's happening, mean for founders who are just starting? Is it just they have to tighten their belt and hold their breath? Do they have to be scrappy? Do they have to raise other sources of capital? How do you see companies getting started before they get to your stage?
The first thing I would say, it doesn't feel this way, but this is good. In a world where you think there's unlimited capital, just think about yourself and individual budgeting decisions in your life. You aren't making hard trade-offs or constraints, and you're not solving the crux of the matter sometimes. So I think the fact that there's less just tons of capital and how much you could raise before you actually have something like real revenue and market, look, I think that's good. What I will say is, look, what's happened in 18 months? In 18 months ago, if you got to $1 million in ARR, you could raise a round from a Series A investor at potentially 100x ARR. What's changed? And they didn't care how much you'd raised up to that point. That wasn't helpful to founders, because even if you raise that round, you're screwed beyond there, because you don't really have, you're still a feature, you're not a company, and you get this false dopamine hit where the fall from that is much more. I'd say 80% of the calls I have with founders, I tell them, you have a really interesting business. It's not ready for seed. I either tell them to not raise venture, raise alternative source of capital, and bootstrap this thing, because you'll have a much happier life and you end up with far more money than going down the VC gravy train. Or I say, look, go raise $1 million. In my mind, if you can't raise $1 million and get to a product in market and a couple $100K in ARR, you kind of got to ask yourself. Now, this is in SaaS. If you're doing hard infrastructure, like deep tech, biotech, that's different, right? But look, I think if you raise $1 million to $1.5 million between a friends and family angel round and a pre-seed, I think you can do that. Like, I think that opportunity still exists. I don't see the pre-seeds backing away. I love the pre-seeds. The only problem with the pre-seeds is that they end up setting an anchoring price in the in the founder's mind in terms of what their next round valuation is, and I have to reset the expectation. One, that's not the case. And then two, I often have to go back to the pre-seeds and tell them there's not enough equity left for the founding team. Because I don't want to leave a seed round where I don't have at least 50% for the founders or co-founders in. So those are always fun conversations.
Yeah. I'd say this, Brett, like when the pre-seeds don't do the pre-seed VCs, when they don't do the hard work of having the hard conversations with the founders, they're just kicking it down the path to straight shooters like you and your partner, Mark, who I know very well. Both of you guys aren't afraid to, knock some sense into some founders and be like, you're just overvalued, right? So I think that's actually some of the conversation that I've been having with a lot of founders, which is to help them reset expectations. And I either have a tweet or an essay that's like, happiness is the disparity, is the delta between, expectations and reality. And what I think has happened a lot in the last year is that a lot of founders who came into the world of startups in 21 and 22 heard about what people were raising at, the multiples that people were raising at, and then get to today and things are different. And so they're just like really distorted in their heads. And I'm like, your company has been around for 3 months and you're mad that it's worth 5 million and not $10 million. And I'm like, think about this.
It's all silly, Jason, right? Like, we're seed investors. I care about what the value of the company is in 10 years. And people will tell you, for companies that go public, 90% of their value creation, like 90% of the wealth creation for a founder is year 11 through 20. So like what somebody values you today and how many hugs you got or how many kudos you got on your Slack feed doesn't matter. So you have to start with sort of the end goal and work back from there. And then as a founder, you have to figure out the business you have and how much work you're going to do and how much dilution makes sense. And that's when I say people aren't right for venture. That's not a bad thing, but like venture is like, you have to get to 100 million in revenue. And like, that's really fucking hard. That's like 1% of all software companies. And if you go down that path and that's not your business, you're going to be unhappy. You're going to be measuring yourself against some expectation that you chose, which isn't fair. You're going to look at a business, you can have a business that's $12 million. Customers love it. It's growing 30% a year. And God forbid, you could sell it to a private equity firm and make generational wealth. But if you use it against, oh, my triply, double, my VCs don't think you're going to return the fund, I'm a loser. You kind of just did that to yourself. So it's all about setting the expectations correctly.
Awesome. Well, I'm glad we were able to have this level setting conversation. So much of the value, Peter and Brett, in these workshops and webinars we do is like to get in the mind of the investors, right? We started this whole session before you guys showed up about how important it is to be in the mind of the investor, because you have to present something that fits their model. So what I'd like to do is open it up to questions from the audience. And before anyone gets shy about this, like I will say, it is very hard to get this type of audience between people who have this type of data and knowledge. So don't be shy. I would definitely raise your hand, your digital hand, and we'll go as long as we can before these guys have to jump out. And if no one asks any questions, I'm also happy to just give Henry, you do have a question. So please raise your digital hand. It'll help us find.
Sure. Hey guys.
Henry, before you get started, where in the world are you?
I'm in Cupertino.
Cupertino.
Yep.
Okay, and I'm going to ask you to do the 30 seconds on what your company does. This is your cold call.
You got great hair.
Yeah, thank you. I set it up just for the meeting. This is not mine. This is all GPT based.
Well done.
So we're in the authentication and identity space. We're replacing passkeys and passwords with 3D biometrics. So we are the anti-deepfakes company. So I feel like the question that I have to ask, because I really saw the vertical that you were hitting, which is, hardcore SaaS has its own version, and then deep tech has its own formula, where it's like, when you guys look at a company, you really try to narrow down that vertical and see, okay, looking at statistics, that's where you need to be. That's the valuation. This is where we want to invest, or not, because we've seen this 1,000 times on a specific vertical. So when I look at my company, and I sometimes maybe make a mistake and say we are a SaaS company, But in reality, it might not be the right vertical that I want to present, because right now we're raising $5 million. You know, we raised $500,000, brought us into this where we are today after 18 months, where we don't have contracts. We have letter of intents from government from government entities that we are working with. We have a Fortune 500 company that's going to put us in their marketplace in 2 months from now, and we're working on the SDK to connect to them. So when we come to venture capitalists and right now and say, hey, we're looking to raise, $5 million, you can throw at us any check you feel comfortable with, and we'll do this on a rolling closing kind of a thing. Telling them that we are in the SaaS space is wrong. They have to be, because if there is a portion of what we're doing that is a paid for software, but the reality is we are, pay per authentication. You see what I mean? So it's really, my question is, where do I position myself in a perfect spot in my presentation, not to confuse my investor or potential investor in my pitch?
Is there hardware as part of your solution, or is no hardware?
There is a hardware, but it's another product. So the core is everything is app based, but we have a solution that is also a hardware piece.
Look, I think for your type of solution, you want to go talk to the investors that have deep domain expertise in this space. And they're the people that are going to look at the underlying technology of what you built and the approach that you've taken. And then they'll go talk to your 2 or 3 customers that people are looking to you. They may invest, they would probably invest earlier than we would. So I think first, instead of trying to position yourself to investors, make sure you're picking the investors that are pretty prolific in investing in this area, right? There are quite a few. Look, I think you're a software company. All SaaS means is it's delivered via the cloud, and there's some level of recurring revenue. People got creative with what was recurring and not over the last 6 to 10 years. But I'd be less worried about positioning yourself as a SaaS and more positioning yourself as the best solution to a very large industry that spends a shit ton of money in solving it the wrong way. I don't think people get caught up. But if you want somebody to give you 5 million now when you have no revenue, be ready to give up more dilution, right? Because you don't have revenue. And so that's always the tricky part that founders have. Should I take more now, or can I stage it?
Right.
That's I don't know, Peter, what you think.
No, I think that is perfect. I think that when I'm talking about the differences between these various industries, a lot of it comes down to capital intensity. So if you're creating a new drug from different proteins, you're going to need more capital up front than if you're running a software company, which is a lot of the difference between the dilution metrics that we show. In this case, I completely agree. I think this is a SaaS business for sure. Now, it's maybe a particular kind of SaaS, and I'm sure Jason has many, many different ways to narrow down or find the exact right investors that fit the thesis. But in general, I don't think it's going to be. I think that the question is going to be on how can you get to revenue before you start raising that 5 million. I think would be great if possible.
Yeah, Henry, I'll try to generalize this for everyone else too. And as you think about what you're trying to raise, this is why I'd ask Brett, like, can you describe what you're looking for subjectively, not numbers, but what does Brett believe a company is ready for the seed embodies? And he said things like, his customers, the customers love you. You actually know what product you're selling. And that is what people are going to judge you against when you go to raise $5 million. It happens to be that that's one of the metrics. That's the way investors decide whether or not customers actually love your product, because you are going to have to convince them that customers love your product. And if they're not paying for your product in a significant way, then you're just going to have to figure out a different way to describe that. If you can do that, then you'll be able to raise the 5, or you'll be able to raise money. If not, then you're going to have to find money to get to the point where you have metrics that actually support that sort of subjective feeling that an investor needs to see. Does that make sense?
And Jason, I don't want to overgeneralize for all seed firms. We invest primarily at the application layer, do a lot of vertical investments, et cetera. The 2 exceptions to the rule where people will invest large seed rounds before you have that traction are, one, if you've got a freemium model, that you have a ton of usage on the free side and you have the beginnings of monetization, but you explicitly chose to have freemium to get ubiquity, and then monetization ladders. The other one is if you have far better tech. Like if your tech is a true technical innovation, people will invest earlier than 3 to 400K in revenue. They just need to be able to validate that. So either they have somebody on their team or experts they can refer to that can vet that your technology is significantly better, or they hear from your customers or potential pilot partners that they believe the technology is better. So I don't want to make sure you think of the bonfire way as the only way to think about when you would go raise seed.
No, that's great. And yeah, it makes sense to make sure that people understand what do they need to convince people of. Revenue is one way, but you're right. Freemium, other traction, great tech, etc. So we're going to
Thank you so much for the answer. I actually clarified something I needed. I appreciate that.
Thanks, Henry. We're going to prioritize people that have their cameras on. So would you mind popping your camera on if you want to ask a question? And then we'll be able to actually go to the next one. Okay. Bojan.
Hi, Bojan.
Hi.
Hi. Where in the world are you?
I'm actually in San Jose here in California. It's not sunny, unfortunately, but
amazing. Well, I'm going to make sure that you get the practice reps that I always drive towards. So before we ask your question, 30 seconds on what you do.
Yeah, I'm working on a consumer engagement platform, but for brick and mortar. So think about it. When you log into Amazon, they know everything about you in a second. They can upsell you, cross-sell you, and so on. Whereas brick and mortar, they have no capability of such. They don't know when you're in the store. They don't know where in the store you are and so on. So I have a platform using my previous background in my previous company that was acquired something like 6 months ago, to basically provide these kind of capabilities to businesses.
Great. What's your question? Good job.
So my question is, obviously my company is SaaS, so it fits into this, but it's not just B2B, it's B2B2C. And I just wanted to hear from your colleagues and you, if you have any suggestion how to pitch these things to VCs, because it's kind of more challenging you have a chicken and egg situation. You have to have businesses that they adopt your solution, but then you also have to have consumers that adopt your solution. So what would be the best, I don't know, pitch or explanation how to pitch B2B2C? Because, for example, you have companies like Uber, it's B2B2C. You have to have 10 cars and you have to have customers. So what would be the best pitch for this? Thank you.
I'll say just the simplest few words about this. There's not going to be a template, a one-size-fits-all way that you pitch B2B2C that will resonate with everyone. I think the challenge that I give to everyone, whether or not you're B2B, B2C, or B2B2C, is that you really want to go with the simplest version of your description of your company first, enough to get people to ask questions where you can give the additional layers of detail. So your challenge at first should be, can I come up with the simplest version of the story that gets people to lean in, knowing that there is, same thing with Uber, right? Uber solved a problem for the consumer. Like, you might want to choose which problem is the most. Is it the B2C problem? Is it the B2B problem? You might want to start there. And as people get excited about one of the elements of that thing, you're then able to take a step deeper into sharing, well, there's actually 2 levels of this. We go B2B first and then B2C. One of the more common mistakes is to go brain dump everything about my company, and then it sort of twists people around where they don't know where to focus on first. So that's general direction I give you.
Okay, appreciate it.
Yeah, I think there's nothing, we invest in B2B2C, B2B, we don't do B2C. The only thing on B2B2C is that explain that where's the big value aha, either for the C or the B part, and where are the friction points? Often in B2B2C, from a product perspective, there's 2 friction points you have to solve. One, the business needs to really want this and adopt it and love it. And then 2, often the consumer needs to engage. So often the threshold for user experience, especially on the consumer side, is much higher, because if they don't engage, the B part of the B2B2C doesn't get the value. So that's just something to wrestle through. Peter?
Super. Yeah.
Quite honestly, I don't think this is a good question for me.
I
don't
know.
know.
Feel free to pass. Feel free to pass. That's great.
Exactly.
No,
Yeah.
this is super helpful. Hopefully that helped, Bojan.
I
Okay.
appreciate it. Thank you very much.
Okay,
Cheers.
we're gonna try to squeeze in two last ones if we have time. Maybe one more, but we're with Vinod, who has his camera on. Vinod, how are you, man?
Yeah, hi everyone. I'm doing good. Thanks.
Where in the world are you?
Great. So I'm from Amsterdam, and we have a startup called Earth Emission. So it's basically a carbon emissions management SaaS for B2B. So yeah, we are in the pre-revenue phase. Currently, we are working with customers to run some pilots with them. Yeah, basically, I have two questions, one for Peter and one for Brett. And the question for Peter is, so based on your data from Carta, so how do you see the traction, the funding traction going towards climate tech and towards the sustainability domain?
I'd say it's one of the stronger categories. If you think about it generally, if you just compare 2023 to 2022, no one is going to come out looking that good except for AI in some cases. It was a down year basically across the board industry-wise. However, I think climate tech held up relatively quite well. Renewable energy was one of the best performing categories for Carta companies last year. And then climate tech more generally, it does get mixed in with other SaaS products, and it's kind of fungible what is and what isn't climate tech a bit. But in general, I think it's a space that investors are looking to invest more into. And I'd be pretty surprised if 2024 wasn't a bigger bounce back year for climate than it is for some of the other places alongside. Some categories are actually not probably going to be very investable by venture capital moving forward, DTC retail, that kind of thing. I think climate has a strong future.
Yeah, thanks, Peter. A quick question to Brett as well. Brett, based on your experience, right? So usually, based on my knowledge, I understand that VCs have certain, range of funds with them, which is allocated for different sectors. So how do you see how much would usually be allocated for climate tech? So usually, with the bunch of amount you have.
Look, we are a smaller firm, right? There's 3 investing partners. We do 2 to 3 deals a year. We are generalists. If we saw 3 amazing climate deals and we thought we're all not competitive with each other and were the best investments we were looking at, we would invest in them. We don't a lot. What you're speaking to tends to be larger firms that, and it tends to be at the Series A, B, and C at the growth side. Although we are seeing, and this is the confusing part to founders, a lot of the mega funds are launching large seed people out on the street. But outside of like the top 20 funds that might have specific people, it's not really relevant for us. I think one thing for you to think about is there are a lot of new climate tech specific funds, which is exciting, right? Yep. It's no longer like, oh, I'm the climate tech partner at A16Z. Like, every week there's a new $50 to $100 million climate fund that's interested in a very long-term return. And quite frankly, I think even in their thesis are trying to balance impact with return to their investors. And I think the LPs they raise from have a different level of economic return, is my understanding, but I don't want to overspeak.
Cool.
Perfect. Thank you so much.
Super helpful. Thanks for the question, Vinod. We have 5 more minutes left with these guys. Before we do our last question, we're going to go with Ian from Beepo. Did want to tell people that check the emails that we send out. We'll send you guys information on Carta, send you information on Bonfire in case you want information about them, and also some of the informational educational programs that we run over at Adamant. We have our cohort-based program, which is done quarterly. We're in the middle of one right now. The next one will be in April. And then we also have our self-guided program, which will do a lot to help you get closer to the motions that you need to understand to be great at fundraising. So last question, we're gonna draw in from Ian. Ian, where in the world are you?
I am in Oakland, California.
Amazing. And we'll do your 30-second cold call before your question. Tell us a little bit about Beepo.
Sure. We are digitizing the tipping economy. It turns out about 50% of all tips are cash-based, and we don't carry cash anymore. That presents a huge issue for service businesses and service workers, and we solve for that.
Amazing. What's your question?
The question with Jason, you kind of brought us into the mindset of investors at the start of the conversation. And so I'm interested in the pressures that are on investors and VC funds, particularly from LPs, but kind of the environment that they are in right now. And sort of how does that manifest for entrepreneurs? I'm particularly interested in fintech, SaaS, pre-seed, but just kind of trying to understand the pressures that the investors are under.
I want to say one quick thought, and then of course Brett is going to be the primary expert here, but maybe we'll ask Peter to answer just to make him feel awkward. No, no, I honestly believe that the pendulum has swung a little bit too hard. I think VCs are getting pressure from LPs on the types of deals that they do, and there's this push for profitability super early. I would like to see VC go back a little bit more aggressive in the next 24 months. I do think we should be investing in the future and realize that there are companies that like Uber who will turn into gigantic cash machines, but take some time. But I think today and where we are right now is a specific place and time. But I'd be curious what Brett thinks.
You know, as a former operator, being a VC is difficult, right? Especially when you're at a firm that is pretty founder friendly. Spend a lot of time with founders, but at the end of the day, we are in the business of making money. Look, I think there is increased pressure on distributions, right? I think at the end of the day, people that have put money in LPs that put money in are looking for a return. But I don't think it should weigh too much into your company, like it's earlier and the rest of it. You know, I think the key for you just to understand when you go to an investor is the weird thing about as a venture capitalist, if you don't lose sight of it, is in any fund, say you do 20 deals, 2 of them should return 80%, 2 of them will return 95% of your returns. And the rest don't really matter. And so I think for you, as you engage VCs and the rest of them is, you know, how do you get them comfortable and exciting that this can be an outsized return for them? And I think that will stay consistent. I think it's just the way to think about it. I don't know, Peter.
One last, all of you matter to us here at Carta, not just 2 out of 20. I want to be clear about that. I think on the last note that I'll make on the VC landscape on the fund side, not the founder side, is that, Ian, I think you're touching on something pretty sad in some ways. I am reasonably certain there are going to be fewer VC funds 2 years from now than there are now, and perhaps considerably fewer. So what does that mean for founders? It means 2 things. One, are you spinning your wheels talking to people who don't have any money to invest and probably won't raise a fund too? It's really difficult to suss that out, but the more that you can, the better. And then 2, it's like about finding your tribe of the right people in venture. It used to be that there's maybe still a counter strategy where it's just like, hey, we're dumb capital, we invest, we don't touch. But more and more, you want to find people like Brett who are going to be active leverage points to your progress with introductions, with capital, with all sorts of different things. So choosing the right investor, I don't think it's ever been more important to get that match right, because some of them, unfortunately, are probably not going to be there when you raise your next round, because this is probably the last fund they're going to raise.
And obviously pre-seed, you want somebody who's you want money. You don't want somebody who's going to do too much damage. But at the end of the day, pre-seed is they take a lot of shots on goal. So you can't get mad at them for not spending a lot of time with you. I think when you pick your seed stage partner, I think that's a really important one.
Can you qualify them nowadays by, to your point, Peter, about like, do they have the money? Can you look at age of fund? What other criteria are going to help us a little bit when we say, yeah, they do or they don't have money, or they may or may not have money?
I mean, as you get down the road, you should be asking that question. Maybe not as bald as, do you have money? That's perhaps not the right way to phrase it. But in some way, shape, or form, yeah, you need to look at like, when was this fund raised? You would assume a deployment time period of 2 to 4 years after the fund was raised. So to deploy the capital, and then, you know, they'll get returns over a 10-year period. So if you're coming to the end of a fund and it's 5 years after that fund was raised, unlikely that they're going to have too much left in the bank. And then certainly you want to talk about, hey, what are your reserve strategies? Is this not so much on pre-seed, but if you get to like seed Series A, is this the kind of investor that's going to be able to take their pro rata in your company and like invest again at you at the B and show real strength there? Those are all kind of questions that I'm sure Jason can walk you through. What's the best way to present that to investors?
Yeah.
Thank you.
We'll start wrapping this up. Ian, you can ask directly. You can say, where in the fund are you? And that's, I think, one of the things that founders don't realize is how much they can do. And there's so much of this, like, can I do that? Can I not do that? And you should be able to ask questions about the VCs you're talking to. You're basically going into a 10-year marriage with them.
Right.
So anyways, I would like to just thank Brett, Peter, carving out all this time. I tell everyone, when people have important jobs and are running big things, it is very hard to nail them down for a 30-minute conversation. Very hard to get open, honest questions answered like this. So Brett, we really appreciate that. Peter, we really appreciate it.
It's not actually true. Like, it's Jason. We have a lot of respect for Jason. Jason's like, can you make this time? And I was like, okay, let's do it. So come on.
I disagree. I disagree. I'm getting paid behind the stage, Brett. You got to ask for more cash up front. What are you doing here? You know? Yeah.
Paid for a spot, 10 grand already. All right.
No, you guys are great. This has been awesome. Like I said, we'll share more information about Brett individually, Bonfire the firm, Peter individually, Carta the firm, in our follow-up email. Please make sure you look out for that. But thank you guys so much. We'll see you at another event, and good luck out there.
Yeah.
Appreciate y'all.
Thank you.
Thank you.
What's your number? Do you wanna meet me the day after? I saw you look over your shoulder. I need to know now, are you gonna come around?
Sticking around reading the comments chat.
I need to know.